Ever grappled with the question, how can I effectively manage my credit and debt? If that's you, you're not alone. Many people struggle with understanding the intricacies of credit and debt management, yet it's a key aspect of personal finance that cannot be overlooked. Imagine your financial life as a ship. Credit and debt are the wind and waves that can either propel your ship forward or capsize it. Properly managed, credit can be a powerful tool, opening doors to opportunities like home ownership, business ventures, or education. On the flip side, poorly managed debt can sink your financial ship, leaving you stranded in a sea of financial instability. The difference between financial freedom and financial distress often lies in how well you manage your credit and debt. It's about striking a balance, knowing when to borrow, how much to borrow, and how to repay. Understanding credit and debt management can significantly improve your financial health and secure your future. To start with, understanding the basics of credit management is vital. So, what is credit? In a nutshell, credit is the trust that allows one party to provide resources to another, where the second party does not reimburse the first party immediately, but promises to do so later. This trust is based on the creditworthiness of the party, which is measured by a credit score. Now let's talk about the credit score. It's a 3-digit number ranging from 300 to 850. The higher your score, the more creditworthy you are deemed by lenders. This score is calculated based on your credit history, which includes factors such as your payment history, the amount of debt you owe, and the length of your credit history. Why is it important to maintain a good credit score? Well, a good credit score not only helps you get approved for credit, but it also gets you the best interest rates. It can even impact other aspects of your life, like renting an apartment or getting a job. So how do you manage your credit? Firstly, make your payments on time. Late or missed payments can seriously damage your score. Secondly, keep an eye on your credit utilization. This is the ratio of your total credit card balances to your total credit card limits. A lower utilization rate is better for your score. Aim to keep it under 30%. Lastly, the length of your credit history matters. The longer your history of responsible credit use, the better your score. So to sum it up, credit management is all about building and maintaining a positive credit history. It's about being responsible with your credit, keeping track of your debts, and making sure you're always able to meet your financial obligations. Remember, a good credit score is your ticket to favorable interest rates and financial opportunities. Now, let's shift gears and delve into the fundamentals of debt management. Debt, in its most basic form, is money that you owe. It can come in various forms, each with its own set of rules and implications. Consumer debt, for example, is generally incurred for personal, family, or household purposes, and can include credit card debt, auto loans, and mortgages. On the other hand, business debt is money borrowed to fund a business or commercial venture. Understanding the different types of debt is crucial, because each kind demands a unique approach for effective management. For instance, high-interest consumer debts like credit card balances should be prioritized for repayment, while low-interest debts such as student loans or mortgages can be managed with regular, consistent payments. The importance of managing your debt effectively cannot be overstated. Mismanaged debt can have a detrimental effect on your personal finance, leading to a vicious cycle of borrowing and repayment. It can also negatively impact your credit score, making it harder for you to secure loans or credit in the future. But fear not, there are strategies available to help you reduce your debt. One popular method is the snowball strategy, where you focus on paying off your smallest debts first, creating momentum as you move on to larger ones. Another is the avalanche method, where you target debts with the highest interest rates first, thus reducing the total amount you'll have to pay over time. Debt consolidation is another tactic, where you combine all your debts into one single loan with a lower interest rate, making repayment simpler and more manageable. And if you're really struggling, seeking professional help from a credit counselor or a debt management company can be a lifesaver. Remember, the goal isn't necessarily to be debt-free, but rather to manage your debts in a way that allows you to live comfortably and work towards your financial goals. Effective debt management means less stress, more financial freedom, and a path to a secure financial future. Now that you have a basic understanding, here's a step-by-step guide to managing your credit and debt. Let's start with step 1, budgeting. A well-structured budget is the foundation of good financial health. It's crucial to know where your money is going and to ensure that your income covers your expenses. Track your spending and identify areas where you can cut back. Every dollar saved is a dollar that can go towards reducing your debt. Step 2 is all about making timely payments. It's important to pay your bills on time every time. This not only helps you avoid late fees, but it also positively impacts your credit score. Consider setting up automatic payments or reminders to help you stay on top of your bills. Reducing your debt is step 3. Focus on paying off your debts, starting with the ones with the highest interest rates. This strategy, known as the avalanche method, will save you money in the long run. If you have multiple debts, another strategy you could use is the snowball method, where you start by paying off the smallest debt first to build momentum. Monitoring your credit score is step 4. Your credit score is a reflection of your creditworthiness. Keep an eye on it and take steps to improve it where necessary. Remember, a good credit score can help you secure loans at favorable terms in the future. Finally, step 5 is seeking professional help if needed. Don't hesitate to reach out to a credit counselor or financial advisor if you're struggling with debt management. They can provide you with valuable tools and advice to help you navigate your situation. Each step is crucial and builds on the last, paving the way to effective credit and debt management. Remember, consistency is key. It may take time, but with patience and determination, you can improve your financial health. With these steps, you can take control of your financial health and navigate towards a debt-free future. In today's discussion, we've covered a lot. Let's quickly recap. We started off with an introduction to credit and debt, illuminating their importance in our financial lives. We dove into the basics of credit management, highlighting the significance of maintaining a good credit score and the role it plays in securing loans or credit cards. Next, we explored the fundamentals of debt management. We underscored the necessity of keeping debts under control, avoiding high-interest loans, and prioritizing repayment to prevent debt accumulation. Finally, we shared a step-by-step guide to manage credit and debt effectively. From budgeting to saving, from paying bills on time to keeping an eye on your credit score, we discussed various strategies that can lead to financial stability. Remember, managing your credit and debt effectively is the key to financial freedom and stability. Make the right choices today for a secure tomorrow.